Um, now, before starting our discussions, like I think the admin said like your exam would be on 19th of December. That's what I heard. Is that correct?
Sorry, sir, we were not informed about that.
Oh, really? Okay, fine, fine. I think your exams are starting from 5th of December, and then it will be going on, and then this subject might be on 19th of December. That's what I heard. So then we have to, like, we have, excluding this discussion, we would be having three more lectures. That is the schedule for 20 hours altogether, because 3 hours and 3 hours each for 7 lectures. And I thought like if we were unable to like kind of, because like uh, we have spent a little bit more time on interest rate analysis. So sometimes let's see how that works, right? So I just try my level best to finish it off within another three lectures or like discussions. So please like go ahead and study a little bit more. Like I have given the references, so you can read and understand a little bit more on that. Okay, so from the last few discussion, like we were talking about the interest rates, and especially several financial instruments and financial markets. So the last part of that interest rate analysis, the risk and the term structure of interest rate. So first, I think we have done a risk structure of interest rate, and we would be moving to term structure today. So is it correct? Where did we stop last discussion? Which slide number? Anybody can remember? Is it correct? We stopped here. Uh, if anybody can confirm, we can move on. Rangana, I hope this is where we stop, right? No idea. Okay. I'll go from here. If you have any doubts, like you can ask. Okay, we were looking at the risk structure of interest rate. That means like various instruments will have different yield based on the risk structure, right? So basically, we have seen the risk structure. The bonds with the same maturity have different interest rate due to the risk attached to those instruments, right? So there are two important risks. One is default risk, another one is liquidity, like convertibility, right? So these are two major risks, and also tax considerations, right? So these three will have the influence on the interest rate, right? That's what the risk structure all about, right? So we have seen what is the default risk, and like what is the differences between government bonds and the corporate bonds, and how the risk premium is determined, right? We have seen that up to now. Like you could see here, response to an increase in default risk on corporate bonds what will what will be the outcome, like based on risk premium, right? So that means what will be the impact on interest rate between corporate bonds and treasury bonds due to the increase in default risk on corporate bonds. So what will happen, like, okay, the people will have less demand on corporate bonds because like interest rate default risk increased, and then similarly they will switch from corporate bonds to government bonds, so then government bonds will increase. So you can see the price will change accordingly. When the price changes, we know interest rate change, right? So then risk premium you could see from IT2 to like IC2. That is the differences for risk premium. So we have seen this one. So any questions up to now on that? Dilusha, is that okay?
Yes, sir.
All right. So we will continue from that point onwards. I will be rushing through a little bit. So if you have any issue, just stop me at any time and you can raise the questions. So now you can see these bond ratings by Moody's or S&P and Fitch, right? So like mostly, like even though the letters are different, right, assessments are merely same and the definition also merely same, right? So whenever you just try to invest on these bonds, like everybody wanted to have the rating first, so it's applicable to across any lenders. Like they would see, like they would like to see what is the rating. Even if somebody is going to lend Sri Lanka, then definitely they will look into the rating. So here you can see I have given the rating scales now, Moody's, S&P, Fitch ratings with the definitions. Now if it is triple A, then it's a prime maximum safety. That's what they are giving, right? Or like you can see, like every notch below the definition changes, something like high grade, high quality, or like upper medium grade, lower grade, non-investment grade. So if it is like below BB plus, or like according to Moody's rating, like if it is a BA1, then non-investment grade, right? So like any investor like looking at this non-investment grade, they will be very reluctant to invest on that unless there's a very high interest rate or interest rate premium attached to those bonds, right? So you could see, like, okay, even you will go until CCC is substantial risk, and which says D as well, it's default, right? But Modi stopped there. C, it's maybe in default. All right. So this is the rating for sake of understanding I have given. So it's based on the risk appetite of those institutions, right? So it's also anyway subjective based on the rating agency's model and their preferences and their objective, right? Okay, so that's what always this accuracy of these ratings are under scrutiny or like question, right? But anyway, it's worldwide across the globe, right? It's accepted ratings, right? Now just as an example, now you could see a global financial crisis, right? 2007-8 period and continuously until the impact felt until 11-12, right? During that period, starting in August 2007, the collapse of the subprime mortgage market led to large losses among financial institutions. You might be knowing even Lehman Brothers, collapse. It's very big investment bank in US and having a lot of contagion effect on all other countries and the financial institutions. As a consequence, many investors began to doubt the financial health of corporations with low credit ratings, such as BAA, and even the reliability of the rating themselves. The perceived increase in default risk for BAA bonds made them less desirable at any given price. So, if something happened, like you might be seeing from the empirical research, even if somebody is in the board, like marginally above the accepted quality, so they are the institution immediately have impact due to this kind of crisis, right? So during this period, even so many financial institutions started to, collapse. The main reason is the, doubtfulness. If somebody like you take risk, but you will have more doubts or uncertainty over those investments. So definitely, like their share price immediately come down without any other impact, right? The share market crashes. So whoever like in the border, like very strong companies, they can, absorb the losses, right? Um, but the small companies, right, or who are like managing marginally, even you could see Northern Rock from UK, it's collapsed, right? So it's a very strong bank, but due to this kind of adjustments, market adjustments, and they couldn't go for, a financial market to borrow, so collapse. So so many reasons, but the 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 aspect we are talking here is the rating during that time. Okay, if it is like BAA, what is mean by BAA, you could see here, right? So it's lower medium grade, right? Around that time. So lower medium grade, even it's a economy is in a healthy going, so then you will not have any issue, you will be getting more return. But if economy turn around and facing a adverse effect, so then these companies are more risky, then they will be losing. And also so many questions around the rating as well, even AAA or AA corporate bonds and all affected. So there are so many questions around the rating companies as well. So always, even though you have the rating, we should see, okay, in a crisis situations, it won't go as we expect, right? So this is the risk structure of interest rate. And also there is a default risk we were talking about. So some people say default risk, some people say credit risk. Okay, merely like interchangeably we use these words, right? I think the first aspect you are clear on that. So second, liquidity, the relative ease with which an asset can be converted into cash, right? So any assets, if you can convert into cash with short time and less cost or no cost, so that's a high liquid assets, right? So immediately and without losses or with minimal losses. So then two things are very important. So the determinants, one is cost of selling a bond. So if it is a high cost, right, then that's not a high liquid assets, right? And also there should be a number of buyers or sellers in the bond market, so then it's a highly liquid. Now if you can see in Columbus Stock Exchange, some of the shares highly liquid because so many buyers and so many sellers, so every day market moving, in the sense transactions happens. But if you take some of this like shares, right, it's strange, right? Very illiquid shares. The bad side of that is people can easily manipulate, and but if you got into that, you won't be able to sell it again because it's a illiquid shares. All right. So if you feel the bond is liquid, there should be so many buyers or so many sellers. Now, if you take treasury bills and bonds, it's high liquid assets, because like so many buyers, so many sellers, you can immediately sell. There are financial institutions, they will buy it immediately with no cost or maybe very little cost, right? So that's one point you have to remember. And also, whenever like these premiums or risk premiums are determined, right, market determine those risk premium. And third item that should be considered is a tax consideration, so income tax considerations. So when government announce, okay, this is exempted from the tax, right? I could remember like maybe several years back, there were no taxed on FD interest, or there were no taxed on, I could remember like maybe shares as well. I couldn't remember those days. So, or maybe other bonds. I think tax-free bonds, maybe SLDB. I couldn't remember. So the tax consideration also very important in deciding risk premium, right? So in US, the classic example is municipal bonds, right? That is exempted from federal income taxes. So then that also will have impact on risk premium, right? Okay. Now let's assume here, like, okay, we can see an example what will happen, right? What happened between municipal bonds and treasury bonds, right? You can see here we have given two charts. One is A is like very first one is market for municipal bonds, right? This one, and then second market for treasury bonds. As usual, you could see in the y-axis it's a price of bond, and x it's quantity of municipal bonds. Similarly, the second chart, that also y-axis price of bonds, and x the quantity of treasury bonds, right? Now there are supply curves and demand curves are there. Let's see the step one, right? I think you can see, right? Step one, tax-free status shift the demand for municipal bonds to the right. Now let's see, this is the municipal bond. Now the government announced, okay, this is tax-free. Whatever the income you earn from this municipal bond, you don't need to pay taxes, right? So the people like try to or willing to buy municipal bonds, so they increase the demand. The similarly, like whoever like invested on the government treasury bond, they try to switch from government treasury bond to, right, municipal bonds. So while the municipal bonds demand increases, you could see the steps to the shift the demand for treasury bond to the left, so the people will have less demand, right? So you could see the third step with the results that municipal bonds end up with higher price. So demand, when the demand increases, the municipal bonds will the price will go up, right? And the lower interest rate than on treasury bonds. Now the municipal bond price will go up and the treasury bonds price will come down because less demand. When the price goes up for the municipal bond, right, the interest come down, right? So here you could see tax consideration, how the tax consideration affect the interest rate, right? So now you know, right, how liquidity works, how default risk work, and how income tax works. So all these items will have the impact on interest rate. So that's what it says, risk structure, right? So if anybody going to buy any bonds, invest on a bonds, they have to see risk structure, right? Okay. Now one more example you could see, they call it Obama tax during his tenure. Like in 2013, Congress approved legislative favored by the Obama administration to increase the income tax rate on high income taxpayers from 35% to 39%. So what happened during that time? They increased the income tax rate for high income taxpayers, right? So you can see there are tax ladder, right? It will go like, okay, 10, 15, 20, 35. So 35 means if you are paying 35% means your earning is much more than others. So what they did is like they increase 35 to 39, right? So now after changing the tax rate consistent with the supply and demand analysis, the increase in income tax rate for wealthy people helped to lower the interest rate on municipal bonds relative to the interest rate on the treasury bonds. Now, as we discussed, what will happen? Like, okay, now when they increase the income tax rate, what will happen? This wealthy people, they try to buy municipal bonds because it's exempted from income tax, so they can close their brackets, right? So when they try to buy more and more municipal bonds, what will happen? The municipal bond interest rate can come down, because when you buy more municipal bonds, price will go up, then interest rate comes down. So through these income tax initiatives, the interest rate on the municipal bonds relative to the interest rate on treasury bonds are lowered. So these are the real examples, right? So whenever you think in Sri Lankan situation, when the fiscal policies changes, right? So budget, through the budget announcement you can see, so you can foresee, okay, what will happen to our bond, right? Here we didn't have anyway the municipal bonds, so you can categorize, right, what is exempted from tax and what is as a tax. So then you could see, you can focus which one will go up and or which one is down. So up to now, we have seen a risk structure of the interest rate. Any doubts? Any questions? Chaturanga, is that okay?
Yes, sir.
Right, thanks. So now the last part of this interest rate analysis is the term structure of interest rate, right? So you could see the identical bonds, identical in the sense you take two bonds, right? Maybe liquidity risk is same, tax characteristics same, right? Maybe default risk is same, but the remaining maturity may be different, right? That is, so the term structure is different. Then what will happen to the interest rate? So now in this chart, you could see, right?
Excuse me, sir. Chart is not visible.
Is it possible now?
No, sir. It's still not visible for us. The presentation.
Oh, really? What about previously?
It was there, but about couple of minutes ago we lost it, sir. Yeah, now it's visible, sir.
All right, thank you, thank you. Okay, so I'm just moving on to, as I explained, term structure of interest rate. let's assume like everything is similar, identical bonds, right? But only thing is remaining maturity. Maybe one is short term, other one is long term. What will happen to the interest rate? That is the question we are analyzing here. So based on this figure 4 shows like, okay, movements over time of interest rate, movements over time of interest rate on US government bonds with different maturities. Now you can see the pattern here, like everything's moving slightly together, right? But you could see now red is 20-year bond, long-term bond, right? That is like sometimes coming down anyway, but more or less you could see this 20-year bond is with higher interest rate compared to others. The next blue 3 to 5 year a midterm bond, right? That is in the middle. And also you could see 3 months bills. It's always, you know, compared to others, always giving low yield, low interest rate, right? So you could see like these are all bonds and bills. So in terms of default risk, okay, similar, right? In terms of liquidity or similar, you can convert, right? Tax, yes, similar, but only thing is, right, a tenor of these investments are different, if these bonds are different. So the term structure is different. So what will be the impact on the interest rate? You could see if it is a shorter tenor, right, you will have less interest rate, and the longer tenor you will have, you know, high interest rate. Even you can see in our market, this is a similar pattern everywhere. That's because that's a common one, right? Or normal one. Abnormal situation, we can have some different movements. Even you can see 1970, 75, you can see different movements. We will come to that in the next slides. But more or less, that's one thing. And second point, it's moved together. When the interest rate increases, all the interest rates are increases. And whether it's coming down, all the increases, all the interest rates are coming down. All right. So now you should be able to understand, okay, move together, but sometimes, okay, upward trends, right? Most of the time we will discuss later, but sometimes it may be different as well, right? Okay. So when we discuss this term structure of interest rate, now we know, okay, based on different maturities, you will have different yield, right? Okay, if you plot that earlier, this is the plot, interest rate plus years, and you know, interest rate and the remaining maturities. If you plot like this, right, during the period, it's moving like this, right? Okay, so when you see the yield curve from the previous slides, that shows a plot of the yield on bonds with differing terms to maturity, but the same risk, liquidity, and tax consideration. That's clear, right? We discussed. If you see the pattern, normally it's upward sloping. Yield curve always upward sloping, right? That means like long-term rates are above short-term rates. If you see in Sri Lankan market, of course, similar. If you see like, if you take treasury bills, the rates are below the treasury bonds, right? So it's always upward sloping, right? Sometimes maybe flat as well. That means short and long-term rates are same, right? 3 months treasury bill and 1 year treasury bond may be same. Sometimes you also can see this yield curve may be inverted. That means long-term rates are below short-term rates. So then yield curve normally upward sloping, but It can be sometime flat or it can be sometime inverted. Right? It's based on the market conditions anyway, but in a general term, it always upward sloping. Any question? Now what we are going to see is, okay, even though we say, okay, this is a yield curve and the movements are like that, right? To prove that, there are three important theories we have on this term structure of interest rate, right? The theory of the term structure of interest rate must explain the following facts. So three facts these theories should explain, right? One, as we discussed, the interest rate on bonds of different maturities move together over time, right? So now we have seen in the chart figure 4, right? So interest rates move together over time, right? So you should have some theories to explain that movement. And second, when short-term interest rates are low, right, yield curves are more likely to have an upward sloping, right? Let's assume if your interest rate, short-term interest rate, treasury bill interest rate is very low, maybe 3, 4, 5%. So yield curve more likely to move upward slope, right? Move to upward slope. Because okay, we will see the theory. So you can see in the market, right? Upward slope when the treasury bills rates are, or short-term rates are very low. But let's assume the short-term rates are very high. What will happen? So then sometimes it may be inverted. So that means our yield curves are more likely to slope downwards and be inverted, right? So we should see what is the current yield rate for short term. If short term is low, yes, of course, you will have upward slope yield curve. But if the short term interest rate is high, most of the time you will have downward slope. That means inverted yield curve. But as I said earlier, yield curves almost always slope upward, that we discussed. Now, why? The question is why. Now, we have seen in this chart, so all characteristics are there, right? All characteristics are there. So question is why? So the reason is explained through three theories, right? So the first one is expectation theory. So expectation theory explain the first two facts. What are those? Interest rate on bonds of different maturities move together over time. And then when short-term interest rates are low, yield curves are more likely to have an upward slope, right? These are two things they explained by two facts explained by the expectation theory. The second theory, segmented market theory, explain the third fact. What is that? Yield curves almost always slope upward, right? And third, liquidity premium theory combines the two theories to explain all three facts. So now we know this is the scenario, or this is the actual happenings in the market. So then there are theories to explain that. You should understand in economics, most of the theories will be coming out based on the observations, right? If I explain, okay, now you know Taylor rule. If you don't know, that's okay. Just an example, they study, okay, what happens in the Federal Reserve, how they set the interest rate, right? So put it together like empirical data, and see the relationships between each data, and finally they arrive. That is called Taylor rule. Taylor rule says, okay, these are the variables they taken into consideration and calculated like this. So something, everything is from the practical or real world scenario, and they will you will arrive into a theory, right? If you are going to kind of in detail study, okay, you can find out so many variables and say, okay, this is the reason, right, for this real world behavior, right? Normally economics study about always the behavior, real world behavior, right? Okay, so the first one, what I'm going to show is expectation theory, right? So expectation theory, as we discussed, that explain, right? So the interest rate of different maturities moves together, right? And then if you see, okay, short-term interest rate are low, then yield curve will be upward sloping, right? Let's see how that expectation theory explain the situation for us. The interest rate on a long-term bond will equal an average of short-term interest rate that people expect to occur over the life of the long-term bond, right? Are you all following? Is it clear? Okay, let's discuss, and if there's anything, like, stop me, right? Okay, so now the people expect expectation theory means what is the expectation of investors or public, right? Okay, you have short-term interest rate, right? And you will have some expectation for the long term. So based on the expectation, so how the interest rate will be changed, right? That's the overall idea about this. It's basically your expectation, right? Now what will happen, like the interest rate on long term bond, right, that equal an average of short term interest rate. So people expect it to occur over the life of the long term bond, right? And then buyers of bond don't prefer bonds of one maturity over another. They will not hold any quantity of bond if its expected return is less than that of another bond with a different maturity. Now let's assume, like, okay, you may be having different maturities of bond, but if you feel, okay, this bond is giving less yield than other bond, then you're not going to buy that bond, right? That is your expectation. And then third, the bondholders consider bonds with different maturities to be perfect substitute. Now let's assume, now you have so many bonds. If you want to choose one of them, that should be perfect substitute. If you take 1 year bond and 3-year bond, or 3-month treasury bills and 1-year bond, right, you should be able to see the different maturities bond to be a perfect substitute. Then only you can choose one of them. Or two different things, if it is not a substitute, then you cannot choose based on the common ground. Got the idea? So then how do we make it perfect substitute? That is the question. Different maturities you have, but you want to make it perfect substitute, right? So this is all about expectation. So you want to make it perfect substitute, you expect some aspect on that bond, right? Okay, so as we discussed, now you take as an example, let the current rate on 1 year bond be 6%. Right? You are today. Today means we always say T0. Today you're going to buy a bond that's a 1 year bond. The interest rate of that 1 year bond is 6%. And also you expect, that's the expectation theory, you expect the 1 year bond interest rate during the next year would be 8%. Right? Today 6%, but next year might be 8%. This is your expectation. 6% is the actual one, and the next year 8% is the expectation. Now, if you are going to invest, right, or if you are going to buy a 1 year bond, right? Now, if you are going to buy 1 year bond, what would be your expected return? Right? This is the expectation theory. So now your expected return may be like, okay, you feel this year 6%, so next year is 8%, then you will be arriving at an average rate. That means, okay, this year 6% you will earn, next year you expect as 8%, so you will put it together and divide by 2, because 2 years, then your expected return should be 7%. Is that clear? So now, if you are going to buy a 2-year bond, that means you are going to buy 2-year bond this year as well as next year. So 2 years going to cover. So at what rate you expect to buy? It's 7%, because you believe, okay, this year 6%, next year is 8%. So if I'm going to buy, at least I should have that average interest rate. Otherwise, what will happen? You will buy 1 year today, and then you invest the second year. So you will buy 1 year bond, not 2-year bonds. If you buy 1 year, okay, you will 1 year bond, you will get this year 6%, next year 8%. So what will be your average interest? It's 7%. You can switch 1 year first and then you reinvest, right? Then again. So if somebody come and say, okay, I will give you 7%, 2-year bond, now you are in difference. So your expectation is 7%. So when the maturity moves like 1 year to 2 year, then your interest rate increases because of the expectation. Is that clear?
Sir, at this 7% is the minimum that we are expecting from investing on a 2-year bond, no, sir? The minimum
Yes,
amount.
minimum amount. Yes, because that is your expectation. So you expect 8% in the next year. So if somebody is going to give more than that, of course, okay, you are welcome. Minimum interest rate, because your expectation is 8%.
If somebody offers a rate lesser than 7, we should not accept it, no, sir. Ideally,
Exactly, because you are more favorable in investing like for 1 year first 6%, and then second year you will get 8%, right? That is your expectation. So that is then you are going to lose. Okay. I think it has moved somewhere. Yeah, now it's clear.
It's clear, sir.
Okay. Okay. I have given some kind of examples as well. I'm not going to explain the calculation, but you can just read and see. Now here, like you can see in the graph, I just touch upon this graph. This is the first year, 0 to 1 and 1 to 2, right? Now you take like, okay, first at a time you buy 1 year bond, that is the interest rate at 6, and second you reinvest for 8. So altogether first year you will get 6%, second year you will get 8% if you are going to take 1 year bond and reinvest, right, at the maturity. But somebody is going to say, okay, I will give you 2 year bond at 7%. So you calculate and see, of course, that is equal to your previous return. So why don't you invest on 2 year bond? So at least 7% you will expect, right? That's what we discussed. Now there are calculations you could see, right? It's basically a very simple calculations, right? How do you arrive that expected return, right? So the final formula, you could see the expected return for holding the 2-period bond for 2 period is like 2, it's a 2 period, like 2 interest rate or 2t, right? This denotes are like for 2-period interest rate, right? Clear? You can see like that's not a big deal. So yeah, just want to make one point, right? Here, like if you simplify this formula, I will go to, sorry, right? This formula, you will have 3. Can you see me my pointer here on the slides?
Yes, we can see.
Yes, please. Okay. So here, like I will just explain this line only, right? So the first year interest and second year interest, and this is, you know what, this portion, anybody? The third item, okay, you think of like slightly. I said, okay, first year you will get 6%, thousand rupees worth of treasury bonds you invest, and first year you will get maybe 1060 with the 6. Okay, I'll go with 100 then. You invest on 100. End of 1 year, how much you will get?
106.
106. Very good. So now you're going to reinvest the 1 year bond. Again, 100 rupee investment. Then you will get how much?
8%.
Yeah, 108, right? 108 rupees. Now the problem is when you, after 1 year, you will get 106, right? You have 6 rupees in addition. That 6 rupees also you are going to, if you are going to reinvest, so 6, for that 6 rupees, you will get additional what? 8% interest on that 6, right? It's a compounding. So now this, the third one is talk about that, right? So, but normally in a simple calculation, if it is an exam, definitely we have to, anyway, we have to cater that. But in a simple understanding, it's very, very immaterial item. That's what people omit that part. And normally in simplicity, we take the first year interest and second year interest, expected interest, right? If you calculate and see, you would see like maybe very small, that's immaterial. So simply we ignore that, right? Okay, so finally the expectation theory, right, give you not only 2 period but n periods, maybe 5-year bond or 8-year bond. If you are going to compare, right, a perfect substitute, you are going to adjust the interest. That's what the expectation theory says, right? Based on this calculation, expectation theory says, okay, the interest rates are moving together, right? When the short term increases, long term increases, right? Moving together, because the calculation is as such, your expectation, right? And also, right, it expects, right, when the short term rate is low, long term rate is higher. That's expected. Short term rate is 6, then long term rate is 8, right? That is the explanation for the real behavior of the behavior of interest rate in the real world, right? So now you could see, based on this expectation theory, now you can understand why the term structure of interest rate changes at different times, right? When the time changes, interest rate changes. And also why interest rate on bonds with different maturities move together over time. That's a fact one, we say. The 8 items we show, that's a fact one. And why yield curves tend to slope upward when short-term rates are low, and vice versa, right? So expectation theory explained to you, because based on your expectation, right, the movements would be, as we discussed, move together and upward slope. Is it clear? So basically the characteristics is explained, or the pattern is explained through expectation theory. If it in an exam, like if the exam or questions ask you to explain the movements of the interest rate through expectation theory, we would be able to explain the facts and the and we should be able to elaborate with the chart, right? Or at least the kind of examples. Any question? If that is okay, we will be moving on to segmented market theory. So what segmented market theory says, so you are going to segment the market for different maturities, right? Bonds of different maturities are not substitutes at all. Earlier we thought, or like the expectation theory, right, it make it as substitutes and adjust the interest rate. Segmented market theory capture that real differences. The bonds of different maturities are not substitutes as well, because like 3-month treasury bill is total different from 1-year bond. It's not a substitute, right? So the interest rate of each bond with a different maturity is determined by the demand for and supply of that bond. Now treasury bills, the rate is determined by the demand and supply for that bond. But treasury bonds rates are determined by the demand and supply of the treasury bonds. And also the investors have preferences for bonds of one maturity over another. I may be willing to buy 3-month treasury bills, and you will be looking at for 1-year bond, right? So then we have our own preferences over maturity, right? So if investors generally prefer bonds with shorter maturities that have less interest rate risk, then this explains why yield curve usually slope upward, right? So the segmented market theory says you're going to segment it, right? Like everybody has their own preferences, right? So, but what they expect is, if you prefer for like short term, the interest rate risk is less. If you go for long term, interest rate risk is high. So when the risk is increasing over time, right, or longer tenor, then you will have risk premium for increasing due to the longer tenor. So then you can see the yield curve here explained by upward sloping. Is it clear? What do you mean by interest rate risk? If anybody can explain. Interest rate risk. Chaminda? Come on, you are from banks, right? You should be able to give some hint. Chaminda, can you hear me? Or Rangana?
Probable losses that might create due to fluctuations in interest rates in the future.
Exactly. So, like very specific and precise answer. Yeah, that is called interest rate risk. Now, the segmented market theory says, um, okay, so now if it is a very short term, right? You don't expect that kind of interest rate risk, because like when the interest rate changes, you can reprice it, right? Now 3 months, you have locked your investment for 3 months, treasury bill 6%, and now, okay, after 1 or 2 months it's going to be 8%. So then after 3 months you can anyway reinvest it at 8%, because every time, like, you can very short period, within a short period you can reprice it, in the sense you can reinvest and get a good price. But if you lock a bond for 5 years at 5%, now after 6 months it goes to 6% or 7%, you have to wait until 5 years to get it at maturity and reinvest it. So then your interest rate risk is so high, right? So therefore the segmented market here says, okay, everybody has their own preferences, right? But investors generally prefer bonds with shorter maturities that have less interest rate risk. This is what it says. So when you go with less interest rate risk, then your risk premium is less, right? So then the interest rate will be low for short term and high for long term. So this explains why the yield curve being as upward sloping, right? Okay, the final liquidity premium and preferred habitat theories, that is like put it together and explain, right, all these observations. So the previous theories, that means like expectation theory and segmented market theory, put it together and explain, right, how the yield curve would be. You can see here. Now, this part, the very first part, seems to be like for end period, right? The interest rate, this first part would be the expectation theory, right? With that, you are going to add some remedy for liquidity. We can call it liquidity premium, right? So when the bond is longer term, your premium might be higher, right? So you will add with this expectation theory formula and you will get the interest rate. So you are going to add liquidity premium, right? Clear? So so then when you see the preferred habitat theory, investors have preference for bonds of one maturity over another. They will be willing to buy bonds of different maturities only if they earn somewhat higher expected return. Yes. And investors are likely to prefer short-term bonds over long-term bonds. It's a preferred habitat theory. Now we can put in a chart and we can see this one, right? So here y-axis interest rate and x years to maturity, and we can see the rate expectation theory yield curve, right? Assume flat, but you are going to add liquidity premium, right? When you add liquidity premium over the period, so it's increasing, right? This is LNT. So a 30-year bond will have this kind of higher liquidity premium. So your yield curve move like this. So liquidity premium preferred habitat theory explain, right, expectation as well as liquidity premium. Is that okay? So liquidity premium preferred habitat theory explain, like as we see facts in the previous slides, interest rates on different maturity bonds move together over time, right? Explained by the first term in the equation we saw. And yield curves tend to slope upward when short-term rates are low and to be inverted when short-term rates are high, we have seen, right? That is explained by the liquidity premium term in the first case and by a low expected average in the second case, right? Now you can see this one, liquidity premium, right? Short term is very low and a long term is high, right? Okay. And then yield curves typically slope upward, explained by a larger liquidity premium as the term to maturity lengths, right? Okay. I may be a little bit fast, but interrupt me if you have any question, right? You could see the figure 6, the yield curves and the market expectations of future short-term interest rate according to the liquidity premium theory. Right? Different terms maturity and yield to maturity, you could see. This can be flat or steeply upward or mildly upward or like downward, right? Based on the expectation of the future short-term interest rate, right? Now, you could see here, right? We earlier discussed if the short-term interest rate is low, then always upward, right? But how much upward? What is the steep? It's based on the liquidity premium. But if you could see the short-term interest rate is high, then we expect downward slope. The steep, it's based on the liquidity premium. Right, the slope, you can see the slopes are based on, right, liquidity premium. And as we discussed earlier, there can be like some yield curve. There's no relationship at all with the maturity and the yield to maturity, right? So those are flat yield curve. Normally we don't see in the market, right? This is kind of the yield curves for US government bonds. These are the, you know, our real world behavior. So it can be anything, right? Most of the time, like if you see the first one, right, dropping down and going downwards because short-term interest rate was very high. So it's downward slope. If it is a kind of low, so it's high, with a high or low, it's based on the economic behavior during the time or expectation, right? So you could see, right? And this extreme cases, if you take high interest rate, downward sloping, and low interest rate, upward sloping, right? So up to now, we have seen the interest rate analysis under three areas. So one, you understood the interest rate, and second, we discussed the behavior of interest rate, and third, we discussed risk structure and the term structure. So this is the interest rate all about. Anybody wants to have any questions out of this area, interest rate analysis? Is that okay? Raja Karuna, is that okay?
Yes, sir.
Okay. So then if that is the case, so then we can move on to our next topic. That is, if you see here, right, these are our topics. The third one, like we covered first one, money and the financial system. And second, we covered interest rate, financial instruments, and financial markets. And then third, we are going to discuss about financial institutions, right? That is our third area. If there's no questions under interest rate analysis, we can move on to our third area. Shall we? In this area, actually, yeah, Rangana, is there any question?
No, no, sir.
All right, all right. Okay, so in this discussion, what we are going to actually discuss is, okay, how a financial system promote economic efficiency. How important are these financial institutions, right? How these financial institutions, why we need actually financial institutions, and how they support to promote economic efficiency. So this is our third area, right? So see an example in this chart, right? This chart based on the developed countries, right? Or US, German, Japan, and Canada, how the source of external funds for non-financial businesses are funded, right? So all these non-financial institutions in these four countries, how they are getting external funds. If you see, right, which one is higher? Now we have given bank loans, non-bank loans, bonds, and stocks. That means equities, right? Equity investments and bonds or debt instruments, and bank loans, other non-bank loans, right? So which one is greater? We could see, right? If you take, of course, US is a little bit less anyway, but German, Japan, and Canada, you see 76%, 78%, 56% of these non-financial businesses are funded by banks through bank loans, right? But if you take the US market, of course, bank loans and non-bank loans also very important, and bonds, right? Stock is very less anyway, right? Meaning less equity, and the US is like highly developed financial market, so you can issue bonds easily and get money. So that's what it's like 32%. And non-bank loans also you can get it, right? So 38%, because there are, other than banks, there are so many financial institutions, you can get funding from them. Anybody wants
So
to?
what do you mean by non-financial businesses? What are the examples?
Yeah, normally like financial businesses, whoever like dealing with finance, right? Banks, finance companies, insurance, stockbrokers, these are financial businesses. Non-financial businesses, or maybe John Keel's, Dialogue, all these companies are in non-finance businesses. That means buying and selling, manufacturing, anything. Got it?
Okay, sir.
Yeah, normally here, like what we have to see is like a in a local like our Sri Lankan context, okay, take a John Kills as non-financial business. They don't go into financial business, right? Investment, deposit taking, giving loans, these are the financial businesses, right? So they like, okay, hotel sector, they are having hotels. How they are getting external fund? Maybe through equity, maybe through bank loans, maybe through other direct loans from other parties, or maybe from a debenture, or maybe bonds, right? So they can get their finance through various means. It's an example. So if you take as a global, these four countries, how they are getting the non-financial businesses, how they are getting external funding, right? Okay, so you could see here the mostly, except US, but US also like somewhat significantly involving in getting external funds from bank loans, by banks, right? Okay, so this itself show you how important are these banks, right? Okay. According to these facts, right, this basic real world scenario, you can arrive into facts, right? You could see the first one is the stocks. Stock means the shares. The stocks are not the most important source of external financing for a business. We agree, because you could see only maybe 10 to 15%. And second, issuing marketable debt and equity securities is not the primary way in which business finance their operations. Yes, right? So marketable debt and equity securities are not primary source of funding. Third, indirect finance is many times more important than direct finance. You could see, right? Indirect finance. Indirect finance means what? Now for time being, think, okay, banks loans are indirect finance. So they are very significant. That is another fact, right? And fourth, financial intermediaries, particularly banks, are the most important source of external funds used to finance businesses, right? We could see from here, yes, of course. And then the basic facts number 5 is financial system is among the most heavily regulated sectors of the economy, right? Why? Because financial system provides funding. That means transfer funds from surplus unit to deficit unit. So that's what it's heavily regulated. So that's a fifth fact. And six, only large, well-established corporations have easy access to securities market to finance their activities. Even you can see in Sri Lanka, big companies, okay, they can go for securities market. They can list their debentures and borrow. They can go for IPO and list their shares and get the fund. But can other companies do that? No. So then only large, well-established corporations, maybe John Case, maybe Dialog, those companies, right? But if you take an economy like 80% are small and medium scale enterprises, they have no option to go for like, securities markets. So they all bunch of these enterprises are depends on banks loans. So number 7, the basic facts. Number 7 is collateral is a prevalent feature of debt contracts for both household and business, right? So whoever going for a debt, you should have collateral, right? That is the prevalent feature in a debt contract. Without a collateral, it's very difficult to have a clean debt contract in the real world, right? And the last one, debt contracts are extremely complicated legal documents, and that place substantial restrictive covenants on borrowers. Now, if you are going to sign a loan agreement, let's assume for a simplicity like loan agreement, you are going to borrow from banks, right? So you will have a very complicated legal document to be signed, and then there may be a lot of terms and conditions, covenants, like your balance sheet covenants, maybe on your balance sheet or maybe on P&L. You will have so many covenants, right? So these are the basic facts about financial structure throughout the world. If you see now, based on this chart, you can arrive this conclusion and additional aspect as well. So 8 items you can observe any in any financial system, right? If you just want to analyze a financial structure of a country, you would think of all these 8 items. Is that okay? Any question? Or if you all are following, that's good. Okay, so now the major issue is when you have this funding, the major issue is transaction cost. Right? So when you have this significant transaction cost, the major issue is like, okay, you cannot go for variety of diversification, okay, wide range of diversification when the transaction costs are higher. So transaction cost limit your ability to carry out diversification, right? Now let's assume now you are a non-financial businesses, you are going to get external funding. You can go one lender, or you can go for second lender. Can you go for hundreds of lenders and get the money? You will have so much of high transaction cost. It's not possible. One or two, of course, you can discuss, you can get the money, but it's not possible for 200, 300 people because high transaction cost. The transaction cost, not only like, don't think about a kind of fund transfer cost. No, like you are going to have this um, agreement seal. So that means you have initial assessment, you have you should have legal documents, you searching cost, especially you have to find out the person. So it's all inclusive, the transaction cost. So if you are going to have more and more diversified group for funding, then that is very restricted because of the huge amount of transaction cost. But the financial intermediaries, when I say financial intermediaries, assume as a bank. So these financial intermediaries, they try to reduce this transaction cost because they put all these investors' funds together. Let's assume all these depositors, they wanted to lend, right? John Kills cannot go to all these depositors and collect the money because its financial cost is huge, right? Or transaction cost I'm referring, right? So then these intermediaries come and play a huge role. What they do is they get all these funding, not only depositors, other borrowers, because like they are expert in the financial intermediaries. So then they put all these funds together and they lend. Through that, right, they can use their expertise, and then they enjoy economies of scale as well. When it comes to like, putting all the money together and lending, so they have that vast or like huge number of customers, both sides, so they can enjoy economies of scale. So the financial intermediaries reduce the transaction cost. And one of the example also, not only banks, we can think of a mutual fund. What they do, the mutual fund sell shares of their own shares to investors and collect the money, and then they invest on stocks and bonds, right? If I'm not, if I'm going to invest as an individual, I have to like, okay, searching cost. I have to see which company is better, John Keels or like Dialogue or Haley's. So I have to study, right? I have to choose each and every companies, different companies. I have to invest, right? So it's a huge burden for me, right? So what can I do? I can go to a mutual fund and invest on their shares. They have all expertise and economies of scale. So they can, invest in various diversified groups. Their job is to always study those and make a wise investment. So they will be much the risk and return perfectly compare with our ability, right? So through these financial intermediaries, we can reduce the transaction cost. Is that okay up to now?
Yes, sir.
Okay. So here, like we in this discussion, we try to see how a financial intermediaries can support to finance businesses. That's what we are looking at here. Our third area is that. So based on the real world, we could see the financial intermediaries are playing a major role. Why? We have given 8 facts, right? So mainly because of the transaction cost, right? Transaction cost minimization due to what? Economies of scale and expertise. So financial intermediaries perform a better role, rather than direct finance, right? Okay. In this context, now let's assume, okay, I'm going to get or borrow or from somebody else, or I'm going to lend, both ways. The problem is information asymmetry, right? Information asymmetry. It's a huge area anyway, like we will look into as much as in a shorter way, right? Now, why? Now I assume Rangana is having money, right, to lend. I am the deficit unit. I wanted some money. Can Rangana lend to me? Rangana, can you?
So can you repeat that?
Yeah. Now, you are surplus unit. You have money. I am a deficit unit. I need money. So will you lend to me? Or can I borrow from you? Are you okay to fund me?
Uh, as long as if my investment is returned, the investment is guaranteed with a return on a specific repayment plan, I can get.
So, how do you ensure that, okay, you will get your money back with the guaranteed return? How do you ensure?
I might
Do you have any?
ask for a collateral.
Okay, still, yeah, you can ask so many, to ensure, but still, do you know anything about me?
Oh yeah, evaluation. I need to carry out a evaluation
Yeah,
on credit.
I agreed. In the sense, like, okay, now the problem is like it's very difficult to make this deal because there's a huge gap on information. So we call it information asymmetry. I know about me 100%, but Rangana can only know about those information, maybe 5% of those information, right? So the information asymmetry prevails there. Not only me, okay, Rangana is having like so much of money. He needs to, okay, he wants to lend those money to various people. But only thing is he doesn't know them, right? So I may be from Colombo, so somebody may be from Kandy, and others may be from Noelia. Who knows? Like you don't get any information, okay, or 90% of their, facts, actual information. So always there's an information asymmetry. What will happen when you have this kind of information asymmetry? You will do adverse selection. Now, let's say there are 10 people requesting money from Rangana. To choose these 10 people, okay, he wants to lend to only 2 people. How does he select? It's very difficult because he doesn't have the full information about all these borrowers. So sometimes this go as kind of adverse selections most of the time. Right? So similarly, the customers are coming to bank, right? The customer knows what is the trouble he is facing, but bank doesn't know. As Rangana said, there may be various mechanism to understand, right? But still, the banks are better compared to like Rangana and bank may be better position because they can reduce, because they have various mechanism to capture those information. They have sufficient expertise. So these bankers can reduce adverse selection. So due to information asymmetry, there's a risk of adverse selection. So the bank can reduce those because they have expertise on that. Due to information asymmetry, not only adverse selection, but also you may have moral hazard. Let's assume like I'm asking from Rangana, okay, Rangana, I wanted to buy a machinery for my production. Give me money. So Rangana also can think, okay. So he is going to produce some more, items. So it's better give money. So he will earn and I will earn and return the money back to him. But after getting the money from Rangana, I can use for anything. I can buy some apartments in Colombo, right? So it's a moral hazard because like he does know about my intention fully, right? I can show everything. Finally, my intention may be vary, and after getting the money, so I can invest on various other projects, which may be too risky, right? So the moral hazard is coming at a later stage after giving the money. So because of this information asymmetry, Rangana can end up with adverse selection or moral hazard problem, right? So when it comes to adverse selections, as I said, it happens before the transaction because like you select the person before doing the transaction. So big risk takers are the often most eager to take out a loan, right? So now the problem is when somebody is going for a loan, that itself shows you, okay, he is in trouble, right? That's what I'm saying like here, like big risk takers are the often most eager to go to a bank to get a loan, right? So that itself risk, but out of that even, right, if you have like information asymmetry, right, you will ended up with losing, right? And moral hazard arises after the transaction has developed. Borrowers may engage in risk-taking activities, right? These are two things because of asymmetric information. Is that clear?
Yes.
Yes. So now you can put it in a different, not only this financial transaction, but also maybe like you think of insurance, right? Now you're doing insurance, maybe a car insurance, right? Somebody is going to get an insurance from you, right? Why he is coming for insurance? Because he knows he is taking a risk. So that is 12 kind of adverse selections, right? And then after getting the insurance, he may think, okay, I have insurance. What is the problem? So he can take more risk. That means he can speed up. He can drive very fast, recklessly. So he can, even he knows, okay, if I hit somebody, like there's an insurance guy is there to pay, or some vehicle, if he get into it, like, damaging others' properties, yes, insurance there. So he will be taking more risk. That is moral hazard. So this can be because of this information asymmetry, it's very difficult to capture those. But we call it agency theory. This whole analysis is based on agency theory. Agency theory analysis how asymmetric information problem affect in economic behavior, right? So we are not going to get into this agency theory in detail, but Now you may be thinking, okay, you can understand, okay, these banks or financial intermediaries can reduce this asymmetric information issue. That means reduce the risk of adverse selection, moral hazard compared to an individual transaction. That's what these financial intermediaries are, very important, right? Normally, we call it this in a theoretical way. We call it lemon problems, right? Um, now, now we can simply say the lemon problems. Like if you are going to sell a car, you are saying, okay, this is my car. I'm going to sell it for 15 million, right? So now the problem is you are showing the car, but even though I just view the car, I cannot get 100% information by driving. Even I cannot get 100% information about the car, right? Because like only the car owner can tell you the full information, because he knows, because he is the owner, he knows what happened to last year, what happened like 2 years back, what are the damages, what he has done, everything known to only the owner, but not the buyer. We call it lemon problems. So if I cannot assess the quality, then I will think of an average price, or because I will think of an, whatever you say, I will think of an average quality, right? I'll pay for that average quality. So that's what I will call then. This maybe this BMW only can go for like average quality wise. So then I will ask 10 million. I will offer for 10 million. So, but you know your car and you know it's the best quality. You are not going to sell me then. You will say, no, mate, this is only 15 million. It's a very good car. Right? The lemon problem creates this information asymmetry that creates, right, these differences. So then what will happen? I will leave out, I'm not going to buy your car at 15 because I couldn't have information, confirm information on the quality. Then I'll go and buy poor quality items or normal car in the market. Right? So this is called a lemon problem because of the information asymmetry. So I will end up with an adverse selection. Is that clear?
Yes, sir.
All right. Now problem we know, okay, we know like, okay, the information asymmetry create adverse selections problems, right? So here, now I've just skipped these slides, right? With an example, I will go how we can solve this adverse problem, adverse selection problem, right? Now, here I have given an example. You might be knowing this Enron issue. Enron in US company, right? They went on to bankruptcy in 2001, right? That was the biggest collapse in US history, right? This Enron collapse, giving us example for information asymmetry, because like within the company, so much of issues, right? Lot of frauds, right? Accounting treatments, even auditors couldn't find. So like the banks, they cannot get a good information from them, sufficient information from them, and accurate information. So when the company collapses, right? So all these financial institutions, whoever funded to this Enron, they had a huge losses. This is one of the example always for information asymmetry, because like the banks outsiders couldn't get, they don't know right information or correct information from this company, right? If you have information asymmetry, so you are taking a huge risk out of that, right? Okay, so this is the adverse selection. Now second, how we are going to look at is moral hazard, right? So moral hazard, so we can, as I explained, after getting into a deal, how the customer is going to behave or how a borrower is going to behave, right? Take a company. Now, John Keels as an example. Who is the owner of John Keels? Who are the owners of John Keels? Right? So there are so many shareholders, right? So many shareholders. Who are managing John Keels? Our old shareholders are managing, get into the management of John Keels. Anybody? Our
Board of directors manage the company?
Yes, Chaturanga. So board of directors managing the company. So shareholders delegate those, rights and powers to the board of directors to manage the company. Now the problem is the objective of these two parties are different, right? Or like in a very simple example, you are a owner of a company and you give it to a person who is a manager. Okay, you manage this company. So you are the owner and you appointed a manager. So after appointing, that means like, okay, you have selected a person, appointed, and now he is running the company. Now the objective of you and this guy, the manager, are different because you wanted to grow your company, get the profit. But manager, he wants to manage the company and get his personal benefit, right? Personal benefit, and he also can build a power in the company. Sometimes he doesn't want to or doesn't worry about the profitability of the firm. Here, like the owner, you are the principal, and the manager is the agent. That's what it's always, discussed under agency theory. So here you will have principal agent problem, right? We call it principal agent problem because like you are giving the managerial right to the agent, but his intention may be different than your intention. So we always will have this principal agent problem, right? So in that sense, right? Okay, I'm not going to bring those facts again. In that context, now question is whether you are going to go for debt or whether you are going to go for equity. When you need the funds, right, you can choose debt or you can choose equity, right? So now if you go for kind of I am the owner, right? If I'm going to borrow, right, your money, now your money, right? So if I'm going to borrow, now I can take any risk because that's not my money, right? So if I'm going to have equity, I don't take that risk. So now the principal agent problems, you can fix it here. Takes an example, bank customer relationship. I'm a customer of a bank, right? I'm going to manage my business through getting money from bank, right? So after bank giving a loan, I can use it for anything. But if I'm going to invest through my pocket, that's mean equity, I don't take that much of risk. So always in a financial structure in the debt market, borrowers have incentive to take on projects that are riskier than lenders would like. That's what these bankers always evaluate the projects, whether he is taking additional risk or higher risk than their expectation. Clear? So how they can solve this moral hazard in debt contracts, as Rangana said? Okay, we will see the net worth. Even he is getting to a loss. If he has net worth, okay, that means capital and other assets in his own, and then collaterals. So moral hazard, if he goes into additional risk taking, even we have some sort of cushions. Not only that, what bankers can do, they can monitor and enforce covenants. In the agreement, loan agreement, you put so many covenants, right? Maybe you can have balance sheet. Okay, you should have this kind of maybe profitability, capital, gearings, you like debt to equity ratios. You will have so many covenants in the agreement, right? Through that, what you do, you discourage undesirable behavior. Now, when you fix the gearing ratio, you restrict them to, go to other places and get the loan. And also you can encourage them desirable behavior, whatever you want, right? So you should have maintain working capital this much, right? And collateral value, right? So you always ask them, right, enforce to have collaterals and regular information you may be getting from them, right? So through this, you can continuously monitor and reduce the moral hazard. So now we have seen in a financial market, right, when the deficit unit is getting money from surplus unit, you always have information asymmetry. So when we have this kind of transaction without financial intermediary, you will have risk of high information asymmetry and risk of adverse selections and moral hazard. But when a banks come into play a role as a financial intermediary, they are expert in reducing information asymmetry. That means making a selection and continuously monitoring the party who is not restricting them to go into moral hazard activities. So the banks can do with their expertise and economics of scale better than individual ourselves, right? So the banks play a major role in this intermediary process. That's what you could see in a structure, a financial structure around the globe. The banks loan more than other debts or equities. So up to now, we understood the importance of financial institutions. These intermediary can reduce the information asymmetry and impact of adverse selection moral hazard. Is that okay? Clear? Any question? Here I have given, okay, asymmetric information problem, that those are two, adverse selection, moral hazard, and what are the tools to solve it, and given the facts also, or the 1 to 8 facts, okay, also here you can look into that, right, based on the slides and our discussions, right? I recalled here again the facts. I will explain again. List of facts. The stocks are not the most important source of external financing, we have seen, and marketable securities are not the primary source of financing. That also we have seen from the chart. You recall the chart and see. Indirect finance is more important than direct finance, right? Banks are most important source of external funds. The financial system is heavily regulated, right? And then the only large, well-established firms can have access to securities market, right? Because not everybody can go and list their shares or bonds. And collateral is prevalent in debt contracts. And 8, debt contracts have numerous restrictive covenants. Why all these facts? Because of 2 reasons. One is adverse selections, other one is moral hazard. Up to now, right, what we have seen, hold on for a while. Okay, any clarifications? Any clarification you need?
So I think we have only 2 tutes with us. This particular tute has not been shared with us. I don't know whether it has been shared, but I just checked with the
Yeah.
classroom as well.
Sure. I'll ask them to upload. I think, yeah, I didn't share with them. That's what happened. Yes. Okay. This evening, like I'll ask them to. I have to check. Yeah, I will ask them to upload. Sorry for that. Okay. Anything additional? Any other issues if we can discuss? Okay, now actually like, so this application part, normally in the textbooks used to give kind of real world applications. I have given that as well for your understanding, right? The under financial development and economic growth, right? Um, you can read this one, right? And if you have any issue, it's only whatever like we studied, how that applicable, how that apply to the real world, right? So just have just go through this one or two slides, and if you have anything, you can discuss as well. I'm just skipping those. All right. And second, now we discuss about this collateral, right? Is anyway like based on the US experience, and you can see, right? When it comes to collateral, even though we see as a tool to mitigate this moral hazard, but that's very complex issue, right? Now, even you can see in Sri Lanka, right? This getting collateral, it's very extremely expensive, very expensive, and then very time consuming. All right. And like Sri Lanka, you know, like, you know, as a bankers, you might be knowing like, okay, something goes wrong with the customer. If you are going for a parate execution, it's not a simple thing to do it, right? And if it is a residential property, so much of issues coming in, right? So due to that, the financial system, or like these bankers, not, you know, using they are unable to use this collateral, right, in a very good sense, or like to avoid these moral hazard problems, right? That's what they always wanted to upfront, wanted to have a good customers through their screening process, because once you go into adverse selections, so then you will have moral hazard immediate. So then you have to like, because moral hazard is coming in the later stage after signing the agreement, or like disburse the loan, right? If you can have selection good, so then you can have, you know, you can reduce moral hazard some extent. So in Sri Lankan context, even that's prevailing. So much of the screening process is very kind of high standard screening process in the banks. Nobody can easily get a loan, in the sense like, okay, I can't say nobody, but it's very, you know, a very streamlined process where you can go into several stages before getting into loan, right? So that's one thing we have to, even we say as a collateral as one of the tool to solve the problem, it's not going to solve all your problem, right? Even if you get a collateral, so you will have so many issues after that. You might be knowing like so many, there are few issues about the banks you could see in the Facebook and all, and so many complaints also came to central banks, so something like that, right? So you can't, like, especially in developing countries and the legal frameworks and all, you cannot be relaxed, step back and relax, because like, even though you have collateral, still you are carrying risk, right? Okay, here as I explained earlier, I have given applications just for you to understand, right? Yeah. Okay. Is China count example to importance of financial development? Why I'm giving this under discussions? You go through these applications and see whether you understood based on the discussion we had, right? Sometimes the questions in your paper may be coming on these applications as well, right? Okay, so today's discussion, I'm going to stop here, 3:30, like 2 hours, and I'll be covering next class for 4 hours with this 1 hour as well, right? I think it was not informed to you earlier. Sorry for that. So this class will be over 3:30, but next class we'll be going beyond 3 hours to finish as per our schedule. Is it okay?
Yes, sir, it's okay.
Yeah. Thank you so much. The problem is like, yeah, please read all these tunes because your question will be coming within these tunes, right? So for exam, get ready with the exams, and few theories and behaviors will be there definitely. So and it will not go beyond these tunes, right? I can assure that within these tunes and each and every area you will get one questions. So this is the third area we are looking at. So then definitely you should be able to tackle the question. So from today onwards, you start reading because like I think like December 19th is very close, right? So thank you so much then.
Sir, one more thing, sir. Can we get past papers pertaining to this subject? Is there any way? Because we have not been shared any.
Yeah, you can get past papers, but only thing is this time we revise the syllabus, right? But you can get the past papers. Even I can inform to admin to like share with you all few past papers. But this time is a little bit the syllabus change, and we can, I think, end of the class we can discuss few questions as well. That might be better, I think. But anyway, I'll ask them to share the questions, past papers questions. Is that okay?
Okay, sir.
All right.
All right. Thank you then.